Thanks for being here. This is a really great venue for us to talk about work. And I know that when I teach, I always get asked, what do you do? What are you working on? And that sort of seems a very mysterious part of our job. So this is a great opportunity. I also know my mother watches these on YouTube late at night. So I'm say hi to my mother in Australia. Okay, so this paper that I'm going to present today is a brand new piece of work that I'm working on with my co-authors at NYU and LSE. And what we do in this paper is provide the first evidence of adverse selection amongst prime borrowers in the US. And we talk about how that is induced by the choice of loan maturity. Okay, so there's about half a dozen different ideas in there that I think I need to explain and motivate before we actually get to the work. Okay, so I'm just going to spend most of the time actually talking about what is adverse selection, and prior to that, why do we even care about adverse selection? Why is that such a big deal? Why would we spend so much time talking about that? So I'm going to do that first and set the table for what is the question that we're answering, and then I'll talk about how we go about it, and then finally I'll briefly present the actual findings that we have at the end. So that's the plan that I have. Okay? So if we think about consumer credit markets, what is their main job? The main job of consumer credit markets, financial markets, is to allow households to smooth consumption over time or to pool or insure against risk. That's basically their two key functions. Okay? So if I have a lot of income coming in the future and not very much income today, then I'd be better off if I could borrow against some of that income and smooth towards today. So I was going to earn $20,000 this year, and I knew I was going to get a good job next year, and I was going to earn $120,000. I'd be better off if I could borrow against that income that's coming in the future and say, you know, consume half-half in each year. And I'm going to be strictly better off because there are diminishing returns to consumption. Okay? The last dollar that I spend when I'm spending $120,000 in a year is going to a sort of, you know, is not giving me a lot of extra marginal utility. Whereas if I'm living very lean this year, an extra dollar would really help me out. I could buy some better groceries, I could go out for once or something like that. I'd get a lot more utility out of that. So consumers would be a lot better off. Okay? However, there's plenty of evidence that households don't actually smooth their consumption anywhere near as much as we would think they would if credit markets were very well functioning. Okay? So let's just talk about what some of that evidence is. Okay, so there's a very nice paper where some economists looked at the Bush tax cut, which was mailed out to you in a check in 2001. And different households received it based on their social security number randomly at different months. So they just literally can't send all those checks out at the same point in time. So there's actually essentially a randomized trial on when you get the money. And what do they show is they show that people basically consume about 20 to 40% of that money in the 3-month period when they receive it. Okay, now if consumers were able to smooth, they would know this was completely foreseeable income. They would have consumed some of it ahead of time, and they might have also saved some of it later on. There's no reason why they would have lumped most of that consumption in that one period in time. In fact, standard, like classic economics would say, well, you know, that should basically count as a shock to their permanent income, and they should smooth that over their entire lives, and we should see almost no bump at all. And there's plenty of other evidence. So you know, used car sales bump up 20, 30% in February when people get their tax refunds mailed to them. Consumption increases about 2 to 3% when people come to the end of their loan payments for an auto loan. Again, completely foreseeable, but it suggests that basically they were constrained in their ability to borrow against the future. And it looks like consumers want to smooth when they are given the opportunity. Okay, so there's another paper where they look at instances where credit card limits are, because of rounding errors and so on, essentially randomly increased for some people, and they show that when the credit limit is increased, people do in fact increase their consumption. Okay, so the basic evidence is that households don't smooth consumption as much as we think that they would, and it seems to be that it's because they're not able to borrow as much as they would like. Okay, so why would that be? Okay, so if we think that I have a demand for credit, why wouldn't the market supply that? Normally we would say in economics, well, the price mechanism should always take care of this. It should just be, well, if you really want to borrow, you should just pay a slightly higher interest rate, and the market will supply that credit, and we should have supply equal demand. We should be at a point where we say, well, you know, given the price, I'm happy to borrow and lend just the amount that's available. And it doesn't seem to be where we're at. Okay? One of the leading explanations for why that is a problem that we call adverse selection. Okay? So that's, in a sense, the giant motivation for why are we doing this. Okay? So now I need to answer the question, what the hell is adverse selection? Okay? So suppose that a household wants to borrow $100 for 1 year and is credit worthy, so they're going to repay their loan. Okay? Now, if the cost of capital to a bank, say, is 10%, then in a perfectly competitive, well-functioning credit market, the household will be asked to pay $110 in a year, and if the credit is worth that much to them, then they will go ahead and do that. So that's a perfectly frictionless scenario. Okay? Adverse selection looks like this. Suppose that there are some other borrowers who are observationally equivalent. So a bank or a creditor can't tell who is who, but some borrowers are less creditworthy. And let's take the example all the way to the extreme and suppose that some borrowers are terrible credit risks and they will just default on any loan that they take at all. Okay, so I can't tell as a creditor whether I'm lending to this guy or to a bad credit risk. Okay, and so this borrower type is private information. Okay, and suppose that half of all borrowers are these bad types. Okay, you can see immediately that that's going to mess up the credit markets pretty dramatically. Okay, so a creditor now cannot ask for a 10% rate of return because half of the loans are not going to be repaid at all. In fact, if you're not going to get anything back on half of the loans, you need to essentially crank up the interest rate a lot to generate an expected return of 10% on average across all of the loans that you issue. So in this extreme example, the creditor would need to ask for an APR of 120%. Okay, so they would need a promised payment of $220 in a year, and only half of their borrowers are going to pay that, and that'll deliver the same cost of capital of 10%. Okay? So step one is that because we're pooling, because I have to borrow alongside observationally equivalent lower quality borrowers, then the interest rates are going to be higher because of that. Adverse selection is going to take that argument one step further. It wouldn't be surprising then if a good quality borrower basically then says, well, I'm just not going to pay 220% APR on a loan, I'll just sit out of the market altogether. Okay? And that is what's called adverse selection, is that we're then left with only the worst quality borrowers in the market. So only the bad types will choose to borrow, and then the creditors aren't going to lend at all. Okay? Then I've only got borrowers who are not going to repay in the future, and the credit market will break down altogether. Now, this is an extreme example, but the basic intuition is that as interest rates increase, which we would normally think would equate supply and demand, the good quality borrowers are going to drop out, and we're going to be left lending only to the bad quality borrowers, and the good quality borrowers will essentially not smooth their consumption or not insure against risks. Okay, so that's adverse selection. The question then is, that's a very nice theory. They've already handed out a couple of Nobel Prizes, Akerlof, Stiglitz, for these very ideas. Then, of course, the question is that a big deal empirically? Do we actually see a lot of evidence of this in the world? It's a very elegant story, but how important is it? Okay, so the first key prediction that we run a test is that if you raise the interest rates, does that lower the average quality of the borrower who ends up taking the loan? Okay, that's sort of at the heart of adverse selection. Problem number one is that we can't measure unobserved borrower credit worthiness. By definition, it's unobserved. We don't have that sitting in the data. Okay, if it was a FICO score or something like that, you can condition a loan, you can offer different interest rates based on all those observable qualities. Okay, well, now we can get around that fairly easily. We can just measure the default rate and say, well, you know, that will be after the fact a measure of the credit worthiness of borrowers. So then what we might do is run a sort of these market experiments. So there are a couple of papers that essentially study data that's produced by credit card companies themselves, who randomly undertake trials where they try to measure some of these effects themselves. Okay, and these are very cool experiments. They have, you know, millions of people in these samples where they just mail out different offerings at different APRs, and then they study the behavior of the borrowers who take those. And the key finding here is that when on the offerings that they mail out that have higher APRs, the default rate is higher. Okay, so if they offer some people credit cards at 12% APR and some people credit cards at 15, the people who accept the 15% rate go on to default more. Okay, so that's consistent with adverse selection. As they crank up the interest rate, the average quality of the borrower who's taking the loan declines, but unfortunately it doesn't really seal the deal on what's going on, okay? Because also higher interest rates might cause you to default more often, okay? We call that in economics, we call that moral hazard or the burden of repayment. It's not surprising that if you ask me a much higher interest rate, I've got a higher payment to make, I may end up defaulting more because of that, okay? So disentangling these two stories becomes very difficult, okay? And in fact, that's the reason why we don't have very much evidence on exactly how strong adverse selection is, okay? Now, there's been some more work done on this in developing economies, where this is an extremely important question. Why can't micro-entrepreneurs get the credit that they need? But most of those require very intricate experimental design that's not really replicable in many other settings, okay? So our big contribution here is to provide the first evidence of this amongst prime US borrowers, okay? So that's what we're going to do, okay? So we're going to show that adverse selection is important, even once we're looking amongst high creditworthy borrowers in the United States. Most of our borrowers have FICO scores well over 700. We're going to show in particular that adverse selection is induced by maturity choice. We're going to show that it's the worst quality borrowers who are more prepared to pay a higher APR to take a longer maturity loan, okay? So a lot of adverse selection is about how much you borrow. We're going to be talking about quantity in a different dimension in terms of how long you get your funds for, okay? And in and of itself, maturity choice is an extremely important part of consumer credit, but we don't really understand very much of it at all. So if you choose a home loan or an auto loan or choose between different types of credit, you're making a maturity choice as one of the key things that you're deciding on, okay? All right, so how are we going to break this problem? So a lot of what I've done here is try to convince you that adverse selection is an important question. We need some evidence to see how big a deal it is. But now I've made the point that really disentangling adverse selection from sort of moral hazard or the fact that higher interest rates cause you to default more, that's a tough thing to do. So we're going to get around that with the following empirical strategy, okay? So suppose that we could randomly take observationally equivalent borrowers and offer them one set of contracts or another, sort of like treatment and control in a randomized medical trial, okay? So suppose we took group A and we offered them they could either take no loan or they could take a short-term loan, say at a 10% APR, okay? And we would observe who took what, and we could measure the default rate on these loans, okay? Now suppose we took another observationally equivalent set of borrowers, so the same FICO scores, same state, same income, so on and so on. We're going to see all these things in the data and control for those. And we offered them exactly the same choices, and we offered them one more option, okay? We also offered them a long maturity loan at a higher APR, so say 13%, okay? And that's roughly the premium you have to pay in our data for a longer maturity loan, okay? Now, what would happen relative to Group A? Okay, so obviously anyone who took a loan over here would prefer to take a loan than no loan at all, and the preferences there wouldn't change. But some people who weren't going to borrow before would take the new loan, and some people who took the short-term loan originally would now swap and decide, oh, you know what, I'll prefer to take that long maturity loan, okay? And in fact, it's that substitution that we're going to focus in on, okay? We're going to think about who are the people who offered in Group A would have taken the short maturity loan, will decide instead to move out to the long maturity loan, okay? We want to know, is that going to be the best set of borrowers who chose here or the worst, okay? And in fact, what are we going to do? We're going to compare the default rate on both of these contracts offered to Group A and Group B. Okay, now I want you to see immediately that what we're doing is we're holding the interest rate, we're holding in fact the entire lending contract itself constant. So we know that we don't have the reverse causality problem. We know that the problem what's not going on is that it's not because the default rate is not going to be different between these guys because they're paying a higher APR or they're borrowing at a different maturity. We're holding that exactly fixed. The only thing that's different is that it's going to be a different pool of borrowers who choose here because some of them will have left to go over here. Okay, so for example, if I'm teaching a class and Mauricio is teaching a class, and all the Australians in my class decide that they can't take, they've come all the way to New York, they don't want to hear another Australian teach corporate finance. They all go to Mauricio's class, and the average IQ in my class goes up. Then it must be that the Australians were not the sharpest knives in the drawer, right? It must be that they were of lower quality. And that's exactly the exercise that we're going to do here. So if the default rate in this group is lower than it is over here, then it must be that the worst quality borrowers took the long-term loan. Or alternatively, if the default rate here goes down, or rather goes up, then it must be that the best quality borrowers migrated to the long-term loan. Okay, so that's the way we're going to break this problem. We're going to study purely selection by holding the contract choice here. What we're not going to do is compare the default rate at this option and here, because that would basically suffer from several problems. First of all, it would capture part of the selection from the short to the long maturity loan. It would also capture the effect that this has a higher APR and a different maturity, so that could affect the default rate. And we'll also have this extra substitution from over here, and we don't know what the quality of these borrowers were because we can't measure their default rate if they don't take a loan at all. Okay, so we're going to purely be making this comparison. Okay, all right. So now let's actually talk about what we've done. So I've set the table all night. This is like a dinner party where you get the meal in the last 2 minutes. Okay, all right. So what are we going to do? We have data from Lending Club, which is one of the two largest online lending platforms in the US. So as a borrower, you sign on to Lending Club, you put in your basic your social security number and so on. It pulls your credit report, it pulls your FICO score, you enter your income. They will actually go in and verify that. So all of the publicly available credit information you have, and then they offer you an interest rate in the amount you would like to borrow at. Okay. Now, Lending Club itself is quite interesting. So every month now, since the beginning of 2014, it's doing about $250 million worth of lending. Okay, so this is a pretty big deal just in and of itself. Okay, what's interesting for us is that starting in 2013, they sort of conducted essentially a sort of pseudo experiment on their platform. Okay, so at the start of 2013. If you borrowed between $10,000 and $16,000, you could only take a short maturity loan. Okay, you were only allowed to borrow at 36 months. Okay, in March they expanded that. So if you wanted to borrow in one of those amounts, you were then offered two choices. You were offered a short maturity loan or a long maturity loan. Okay, so this is just like the experiment that we set up a couple of minutes ago. Okay, to replicate the experiment, what we're going to do is we're going to compare the default rate on the people who took the short maturity loan before the expansion and after. So after the expansion is like Group B, and before is exactly like Group A. And we're going to compare to the default rates on other loans, i.e. different amounts, to borrowers who are observationally equivalent, have the same FICO scores, are in the same state in the same month, to pick up anything else that might be driving differences in default rates. Okay, and I'm not going to show a bunch of regression tables, but essentially there's a lot of things that we're controlling for to rule out that any changes aren't coming from a lot of other sources as well. Okay, so what do we find? So really everything boils down to two numbers here. We find first of all that about 20% of the people who were taking the short maturity loan move on to the long maturity loan. So the number of people here drops by about 20%, okay, relative to everywhere else, all the other amounts. Okay. And so the second question is it the brightest or the worst? Is it the high credit risk guys or the worst? Well, we see that the average default rate drops in this group by about 1%. It's about 1% lower than prior to the change when you could only take the short maturity option. So it's got to be that the worst borrowers decided to move on and take the long maturity loan rather than to take the short maturity option when they had both available to them. Okay? In fact, if we want to interpret that, we think about the fact that the average default rate in the pool went down by 1 percentage point and 20% left. Well, it's got to be that the difference between them was a lot bigger than that to move the average by a whole percentage point. Okay? So in fact, it's got to be that if the average dropped by 1% and 20% left, then it must be that the difference in the expected default rate of the people who left and the people who remained at the short maturity option must be about 5 percentage points different. Okay? Now, amongst these very high quality prime US borrowers, that's a big deal. Okay? So the average default rate in our sample is about 8.6%. Okay? So that's a pretty big change in the expected probability of default based on on maturity choice, where you're only opting out for 2 more years. Okay? So the basic evidence here is that worse quality borrowers then will opt towards long maturity loans, and that even amongst very high quality US borrowers, adverse selection seems to be an important pervasive phenomenon. Okay? So that's essentially our conclusion. Okay? So there's the first paper to provide evidence that adverse selection is important amongst prime borrowers in the US, that it's induced by maturity choice. We essentially have no evidence up until today of that at all. And the implication of this is, first of all, that we can understand, it gives us more insight into why credit markets may not allow consumers to smooth consumption over time. And it also tells us something about that in equilibrium, it could be that there is, in a sense, an under-provision of long-term loans. Not just that the amount of lending may be less, but it may be that people are forced in a way to borrow short-term to avoid pooling with more risky borrowers who take longer-term loans. So, for example, it may be that credit cards, which are essentially a very long-term form of credit, the minimum payment is very low, and you can keep rolling it over for years and years. It may be that the APR on credit cards is extremely high because it essentially attracts the worst quality borrowers. And if you want to opt out of that, you need to take a shorter maturity loan to do so. Okay? Thank you very much.